You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Banks are facing the prospect of new regulations in the near future from the so-called Basel III Endgame. The latest phase of the international accords began in the wake of the global financial crisis, but the current proposal faces tough scrutiny from banks and consumer advocate groups. Proponents of the rules, including Fed Vice Chair Michael Barr, argue that the new rules would increase banking sector resiliency with minimal economic costs. On today's episode, we talk with Greg Baer, President and Chief Executive Officer at the Bank Policy Institute, about the Basel III Endgame's most important proposals, how to weigh the costs and benefits, and what the possible future for the legislation looks like going forward. To give full context, we interviewed Greg last week before Chair Powell's testimony in front of Congress this week, where Powell said there would probably be some major changes to the most recent proposals. Stay tuned. Coming up soon, our interview with Greg Baer, President and Chief Executive Officer at the Bank Policy Institute. But first, a quick market update. Chair Powell testified in front of both chambers of Congress this week, sticking to his usual message that the Fed is taking high inflation very seriously while still acknowledging a strong labor market, the other side of its dual mandate. Also of note, he said that the most recent proposals for bank regulations in the Basel III Endgame are unlikely to be passed in their current form. The process for writing new regulations and releasing them for sufficient review suggests a reproposal is unlikely to pass by the end of this year. Another quick reminder that our interview with Greg Baer later in this episode happened last week, before Chair Powell's testimony. Treasury yields rallied the last 2 weeks after some weak economic data helped cool concerns from the red-hot January CPI. Fed funds futures still suggest market expectations close to 3 rate cuts from the Fed this year, in line with the Fed's last dot plot projections. But yields are well off the 2024 highs we saw a couple weeks ago. January PCE inflation came in as hot as expected, prompting a relief rally as markets found some comfort in the Fed's preferred inflation metric not accelerating worse than most feared. The first revision to Q4 GDP showed slightly lower headline growth, but strength in private domestic demand confirms the economy ended last year on solid footing. This week's February employment report showed job growth slowed to 275,000, while the net revisions to the previous 2 months were negative 167,000. The unemployment rate rose from 3.7% to 3.9%, and average hourly earnings grew only 0.1%. All in all, the report suggested much less overheating than the initial January employment report. The release follows strong February vehicle sales that also gave an early suggestion that January data releases were full of weather disruptions and seasonal adjustment issues. That's all for the market update this time. Now, our interview with Greg Baer. Our guest today is Greg Baer, President and Chief Executive Officer at the Bank Policy Institute. Greg, thanks for coming on the podcast.
Great to be with you.
Our topic today is the Basel III Endgame, what the legislation would require of banks and how it might impact the financial sector and broader economy. There's a lot to unpack here, so I want to give a bit of a roadmap for the conversation, not only to help our listeners follow along, but also to give us, you and me, Greg, some structure. I think it would be good to go through how these Basel III regulations came to be, then move on to the most important new regulations that would come out of it, then talk about the potential impacts, and close with the likelihood of it passing in its current form and some possible alternatives. So first, let's start with how Basel III came to be. Basel is a town in Switzerland where these regulation proposals were made, but in any case, the 3 suggests there were 2 before this one. Greg, what's the important historical context to this Basel III Endgame?
Sure. I mean, the Basel comes from the Basel Committee, which, as you know, is in Basel, Switzerland, a delightful little town. And the basic notion going back, decades now was that it was important to have international, common, consistent capital standards. You don't want banks to arbitrage among jurisdictions based on who imposes the lowest capital charge, the so-called race to the bottom. So every once in a while, global examiners or regulators, gather in Switzerland and try to come up with common rules, which are of increasing complexity and specificity. So the original Basel I was just, 4 or 5 different risk weights for each asset. grouping all corporate loans together, all mortgage loans together, treating them all the same. So it was a very rudimentary approach to capital regulation. As we've moved into 2 and 3, and there's even a debate about whether to call this one 3, 3.1, or 4, the rules have grown more and more complex as you try to become more granular in your assessment of risk.
My understanding is that countries are free to set their own domestic regulations with some flexibility, so those standards you talked about are not entirely uniform. Have other countries participating in these accords adopted many of these regulations already? And why has it taken the US so long to get to this point if they were proposed after the financial crisis? I mean, here we are in February of 2024 talking about some rules that appear to be in reaction to something that happened almost 15 years ago.
You raised some great points. It has certainly been a long time. But to your first point, it's really important. I mean, as I noted, the goal of Basel was to achieve consistency. But I think there's a sort of a flaw in the Basel approach, which is it's really just minimum standards. So each country is free to raise it as much above Basel minimums as it wants, which isn't really consistency. If everybody else is at the Basel level and you're much higher, that's not consistent. And that's basically what we're looking at here. The Bank of England recently did its Basel implementation. They're projecting a 3% increase in capital for their banks. I think Europe is a lot more complex, but I think it's something along those lines at the end of the day. Whereas, the U.S. regulators estimated that for U.S. banks, it would be 16%. And I think that was based on an impact study that was a little dated. I think the real number is probably closer to 20 to 21% on average. So the U.S. has implemented or is proposing to implement Basel in a way very different from the other major jurisdictions. It's also, as you note, taken it a lot longer. I think that's just politics and bureaucracy. I mean, in the U.S., you need to get agreement among the FDIC and the OCC and the Fed. Although, to be fair, in Europe, it's even more complicated. As you have the Commission, the Parliament, the Council, but they seem to have gotten it done a little quicker.
Let's talk now about the biggest regulatory changes proposed in Basel or Basel III. And that pronunciation, Basel, even as a German speaker, if I go back and forth, please excuse me. But
actually, I think the French used to call it ball.
I see. Okay.
Yes, everybody has their own pronunciation.
Lots of different candidates then. Greg, this legislation is incredibly long. What are the changes that are going to make the most impact and the changes that are seen as the most controversial? So what are really the main points that listeners should focus on when it comes to the potential changes to financial regulation?
Sure. Let me just start with some real basics. So it's all about a required capital ratio. In a ratio, the numerator is how much capital you have. The denominator is your assets. Now, the simplest capital ratio is basically a leverage ratio, which basically says we're going to look at your total capital. That's pretty clear these days. It's basically equity. Then the denominator is just all your assets. So treating a treasury security just like a subprime mortgage. That's not a very smart way to approach capital regulation because the risk of those two instruments is very different. So that created the need for what's called risk-based capital. So you would treat a treasury security very differently from a subprime mortgage, and that translates into what's called a risk weight. So a treasury security would get a 0% risk weight. In other words, you don't have to hold any capital against it, whereas a subprime mortgage would get, say, 100% risk weight, which means whatever the required ratio is, that's how much you need. So if it's an 8% requirement, that means if you have a $100 mortgage, you need to hold $8 of capital. If you have a $100 treasury security, you hold $0 in capital. And it sort of varies all with that. So what the Basel proposal really is about is how to weight the risks of all bank assets, which is why you get to 1,000 pages if you're trying to do this with a level of specificity. And in particular, the proposal looks at 4 different types of risk. The first risk is credit risk, pretty obvious that the loan doesn't get repaid. The next is market risk, which is for securities, the risk that they move out of the money due to market movements. The third is operational risk, which is in a lot of ways the oddest, which is basically the risk that something else is going to go wrong. Most people think of that as a cyber event, but that doesn't generally cause losses. What it really boils down to is litigation losses, as those are the largest sort of other type of loss. And then the fourth one, which is pretty obscure, and I don't think we need to get into, is called CVA or credit valuation allowance, which is basically the risk that your derivatives counterparty will default. So it's sort of a special form of credit risk.
And then one thing before we get into the pros and cons as you see it of these regulations is there's a lot of focus on a threshold that is currently set at $750 billion coming down to $100 billion, I believe. Can you talk more about that and how it fits into the context of how people are evaluating the trade-offs of this legislation?
Sure. I mean, this gets very complex. I mean, it's all part of the tailoring debate. Certainly, the proposal for the first time would move the whole Basel process down to $100 billion. It's an interesting question. This really gets into the weeds. At the end of the day, I think the regulators will have to decide whether that's worth it. If some of the changes that we anticipate are made to the proposal, it's probably unlikely that regional banks will have this as their binding constraint. Just to make this more complicated, in the United States, there's actually a statute called the Collins Amendment, one of your dumber statutes, in my opinion. But it basically requires that for U.S. banks, you continue to run the old Basel I standard. That is the most simple, rudimentary standard for measuring capital adequacy, and that your binding constraint is the higher of that or the sort of revised Basel. I think what we're looking at potentially is that, for your average and just about every regional bank, which basically is just out there making loans, they're going to end up bound by the old Basel I. And so all of this is really not going to affect them very much. Again, that's assuming that some of the changes that everybody anticipates are actually made. So it gets very complicated. It's all about binding constraints and whether really it's worth going through all the machinations of calculating your new Basel III, 4 numbers when it isn't probably going to really matter.
Okay, so just to be clear, the risk-weighted assets, all of those new calculations that you talked about earlier, which banks would that apply to if the legislation was passed in its current form?
The proposal is to apply to all banks $100 billion and up. Not coincidentally, are also all the banks that are subject to the Federal Reserve stress test, which we could talk about if you want. So they get sort of the full panoply of Basel. I mean, the interesting thing about the proposal, though, is the U.S. raised some of the credit risk weights above the Basel level, but assuming they go back to Basel, if you're actually a lending bank, you should see on the credit risk side your capital ratios go. In other words, you should be better off, put it that way. We talk about whether the ratio is going up or your capital is going up. Basically, you're better off because Basel III is a more granular look at risk than Basel I. You're basically going to see more delineation by risk, and that generally will favor banks. The way Basel works, though, is if you're seeing an improvement under credit risk, everybody for the first time is now getting a standardized operational risk charge, which is a major offset. If your main business is lending, you're probably going to do pretty well under the proposal.
Your organization, the Bank Policy Institute, has written a lot about how Basel III would be bad for banks, bad for the average consumer, and arguably even unlawful. I think you touched on it there with the Collins Act, I think is the name that you gave. So tell us a bit about your view on the impacts of Basel III. What are the most important pros and cons as you see it?
Well, I think what the most remarkable thing about this proposal has been the sort of public and congressional reaction. Traditionally, banks complain about capital requirements, they're too high, whatever. It's just the banks complaining. This time is quite different. I think the increases are so large, massive in the U.S. and the U.S. alone that it's really gotten the attention of bank customers, and that includes for capital markets, the buy side, so asset managers, funds. They've complained about the proposal because they think that the costs of getting bank intermediation are going to go up. Small business groups have complained because they think that the cost of small business loans is going to go up. Consumer and civil rights groups have complained because the risk weights for mortgage and retail lending are just ahistorically high. So it's been the first time this has ever happened. There was one study that looked at all the comments and found that 97% of the comments on the proposal were adverse. And again, that wasn't just banks talking, that was all their customers talking. So that's never happened in my experience in any rulemaking. I mean, it was always sort of the holy grail for the banking industry that finally their clients and customers would wake up and realize that bank costs actually get translated to customers. And that has finally happened. And I think that's also reflected on the Hill. I think we're at the point now where on the Republican side, every member of Congress has asked, I think, for a withdrawal and reproposal. And then on the Democratic side, I think the great majority of Democrats have not supported the proposal and been pretty critical, particularly of the provisions on mortgage and retail, but also some of them also on the effects on capital markets, small businesses, and other issues. really it's an unprecedented reaction to a regulatory proposal, which I think speaks to just how off-market this proposal is, both with regard to what the true risk weights should be, but also to how far the U.S. has deviated from the actual Basel standard and then also from the implementation in the UK and the EU.
We will get to kind of potential alternatives to the legislation a bit later, but I kind of want to walk through a bit of the positions for some of the proponents of this legislation. So I think the proponents would say that any cost to banks would be outweighed by the benefits of added systemic stability. In a sense, preventing crises is cheaper than cleaning up the mess afterwards. And so the argument goes, to whatever extent customers might face tighter lending standards or higher borrowing costs, well, it's still preferable to the credit crunch that can happen during a financial crisis. How confident are you that Basel III fails this trade-off when it can be very difficult to evaluate crises that don't happen?
I think you have the trade-off exactly right. I mean, certainly there are benefits to higher capital, which are, fewer crises and the attendant costs on the economy. No one would debate that. On the other hand, even the people who emphasize that would not say bank capital requirements should be 100% and that they shouldn't do maturity transformation. It's always going to be a balance. The way we look at it is first just sort of a reality-based assessment. I mean, we've now had quite a bit of time since the global financial crisis, since banks basically doubled or tripled the level of their capital post-2010. Liquidity in terms of the high-quality liquid assets they hold is up, probably 3-4 times. And so we start with, what evidence have we seen that that's not enough? You had sort of a unicorn event with Silicon Valley Bank and Signature, but if you look at the banks, particularly those $100 billion and up, there was no evidence that they needed more capital at that point. In fact, most of them were getting inflows. But certainly, Silicon Valley Bank was an interest rate risk and depositor concentration problem. It was not a capital problem. If you do sort of a reality-based assessment, which includes, COVID, recessions, all kinds of things that have happened over the last 10 years. The notion that U.S. banks are critically undercapitalized, which is what you must believe if you're saying they need 20, 30% more capital, there's no basis in reality for that. We also have, interestingly, the Fed every year does a stress test and requires banks to capitalize against that stress test. And that stress test basically assumes a replay of the global financial crisis and the Great Recession and then some. So it's actually worse than both. And every year, the U.S. banks have sufficient capital, not only to survive a replay of the global financial crisis and Great Recession, but also to remain well capitalized and to continue lending. So unless you believe that the Fed just doesn't know what it's doing on the stress test, that's another pretty good indication that current capital levels are appropriate. And of course, that's been reflected in years of, senior government leaders, whether that's Fed governors and chairs, secretaries of the Treasury, whoever, repeatedly saying that the U.S. banking industry is well capitalized. And there's also the fact that, and I think this preys on the minds of a lot of bankers, when the Basel Accord was announced in 2014, they explicitly said that we're not intending to use this to raise capital. We believe the banks have sufficient capital. They released a quantitative impact showing that it wasn't going to increase capital. And it's really only the U.S. proposed adoption that would result in a massive capital increase. And I think that's why bankers really hate somebody who tries to retrade. And this is like the greatest retrade in regulatory history.
It's interesting that you bring up how these regulations wouldn't have prevented the regional bank failures we saw in March of last year. So how much of this is really just fighting the last war? In a sense, they're trying to prevent the financial crisis of 2008, but that specific flavor of crisis and the next financial crisis or kind of systemic issues will not be the same thing, and really this is just 15 years too late, and we need to evolve to the current landscape a little better.
I think maybe as a political matter, the Silicon Valley Bank eruption had an impact on this proposal. I'm not sure how large the impact is, but as a substantive matter, if you read the 1,000 pages or whatever, really none of it's justified on the grounds of what happened at Silicon Valley Bank. I think largely because there's no justification for doing that. Silicon Valley Bank, and I'm sure you and your listeners know, was a very honest institution. It actually held tons of government securities and very little loans, agency securities as well. And its problem was basically a core asset liability management problem. And then the fact that all of its depositors were on the same Chet stream. That's a pretty unusual situation. it gets more to liquidity than capital. If they'd had another 5-10 percentage points of capital, it wouldn't have made a bit of difference. And it's really just an example of how you need to keep your eye on the interest rate risk management ball and liquidity. It's sort of ironic that, not ironic's the wrong word, it's odd that the most immediate reaction to SVB was to propose something on capital as opposed to liquidity. I do think the agencies are thinking carefully and thoughtfully about liquidity and basically more focused on ensuring discount window access than requiring banks to hold still more securities. But that's the right place to look. The notion that if they'd had more capital, it's just very hard to match up with the facts of Silicon Valley Bank or Signature or any of the others.
If the issues for Silicon Valley Bank and the other two regional banks that failed in March of last year, poor mismanagement, issues that wouldn't necessarily be addressed by Basel III, I think that totally makes sense. But I want to tap into the idea that solvency concerns kind of exacerbated the issues for a lot of those banks. So if I'm a lender or even a borrower, isn't there value in knowing the institutions I'm doing business with aren't as risky as an environment with lower regulation? And my point of this is that when all of this went down in March of last year, a lot of depositors started taking their money out because they were worried, well, if Silicon Valley Bank is going to fail, who's to say that my regional bank might not be next? And people weren't doing the same thing with JP Morgan, Bank of America, or Citi. And so the famous paper from Janet Yellen and George Akerlof looking at the market for used cars basically suggests that a market can function better when people are more confident that they're dealing with people or institutions that will be more likely to keep up with their end of the bargain. And if these regulations go down from that $750 billion threshold to $100 billion, if it just gives a sense to depositors that there are stricter requirements on mid-sized banks, then you won't have the solvency concerns that we saw in March of last year.
Yeah, that's a great question. I think part of the problem with Silicon Valley Bank was that we don't know all the details still, but yes, it was likely insolvent. And so, liquidity support, discount window borrowing would not have saved it, should not have saved it. It was more a matter of allowing for an orderly resolution, which I think could have been done, which would then in turn have meant that they did not need to effectively guarantee the uninsured deposits of the whole industry. I think that was a bad moment, and we'll feel the repercussions of that for a long time. But solvency is certainly important, and if you can demonstrate to the market that you are solvent and liquid, then you're not going to see the run. It's all very psychological. I think the argument against imposing some of these requirements down to $100 billion, and here we're not just talking about capital, but a lot of other things as well. But first, as I noted, it may not even be useful in the sense that they're going to be bound by a different standard anyway. But the other one is just basically one of profitability and the regional bank business model. For example, do you want them calculating their market risk exposure at extreme expense and doubtless employing multiple FTEs when in fact they have no market risk exposure? That's a pretty easy one. We haven't really talked about the long-term debt requirement, which I think came out around the same time. Actually had the same comment due date, unfortunately, made for a bad Christmas for some folks. But basically requires regional banks to begin substituting long-term debt for deposits. There's a justification for doing that. That long-term debt can't run. It's also able to incur loss ahead of the deposit insurance fund in the event that the institution fails. So there are good arguments for doing that. But again, it's a question of calibration. The proposal is that they hold just as much long-term debt as a GSIB, so a JP Morgan, Bank of America, but for a very different reason. It's very complex, but there's a different reason for requiring that of GSIBs, which is to allow a special type of resolution. And also those GSIBs, they're in the market all the time with debt. So even leaving aside credit quality or holding credit quality constant, they will get a better price on their debt than a regional bank simply because they have more of it and it trades more often. So that is an extraordinarily onerous requirement on regional banks. Again, that I think is probably more important than the capital requirements where you actually get some benefit from being a lender. But, you keep adding these things up and, you do worry about a barbell effect where, you end up with community banks and very, very large banks. And then you throw in the fact that, this administration and its regulators are extremely hostile to M&A. So even if you want to sort of throw in the towel and say, okay, we're going to have to get really big, it's not at all clear that you'll be allowed to do so. I think that's got a lot of people concerned, which is, Yeah, sure. It would be nice to have a little more, resiliency, a little more capital. But at some point, are you making the business model really difficult to operate? I also think you've seen, I don't know if you've covered this in prior podcasts, but there is a lot more sensitivity, I think, among depositors. Corporate depositors much more less likely to hold large deposits at, regional mid-sized banks. And so I think that's another pressure, albeit on the other side of the balance sheet.
That issue of mid-sized banks experiencing the costs of this increased regulation, like a GSIB, I think it's worth diving into because how the Fed responded to the regional bank crisis last year was by setting up these emergency facilities under the premise that these banks that were failing were systemically important. They wanted to contain the possibility of systemic contagion. So doesn't that prove that a bank of under $750 billion of assets is actually systemically important, and that regulating banks that are $100 billion and bigger could be a prudent approach to financial regulation?
I think the answer is that by any measure, no one bank under 750 billion, certainly one under 100 billion, is systemically important. I think what they were focused on was the chances that there would be a widespread run across multiple dozens, maybe hundreds of banks that size, and that collectively was systemically important. I think the answer to that, though, is, while Silicon Valley Bank may have been insolvent, the dozens or hundreds of banks they were worried about were not insolvent. They were solvent. The question there is, okay, well, do you want to solve that problem by requiring them to hold vastly more capital and more securities and fewer loans? Or do you actually want to have the Fed ready to lend at the discount window, which my friend Randy Quarles points out, that was actually the purpose of the Fed in 1913. That's why it's called the Federal Reserve. It's not called the Federal Monetary Policy Agency. The whole reason it was set up was to, at times like that, to be a reserve for banks that needed liquidity support. And I do think folks in Washington get this. The answer to that problem is not cut your loans by X percent and hold securities instead or add more capital. The answer, if you have a systemic problem like that is sort of an irrational run on banks that are both solvent and insolvent, the answer there is go to the Fed, borrow it, take care of your short-term problem, but your loans are going to repay and you're going to be fine. It's a very tough, regulatory question. It involves thinking about both capital and liquidity, and sometimes our regulatory apparatus is not so good at thinking holistically. But I do think that's sort of the direction of travel more generally.
That description of the barbell for the industry is really interesting. So, as I picture it, there are small community banks on one end that are dealing with, mom and pop businesses, really know their local community. And then at the other barbell, you have the really big banks. And I heard someone speak recently that talked about how the U.S. financial system is having a bit of an identity crisis. So we have 4,000 or so banks in the US, which is very unusual globally speaking. So if you go to Canada or Europe, a lot of these countries have a handful of highly regulated, very big banks. And the US banking system actually used to be even more fragmented than it is right now. But is there anything wrong, so to speak, if the US banking system transforms into something closer to Europe or Canada, where you do have the barbell, or even just the whole extreme right side of the barbell, which is a handful of huge banks?
Yeah, I give a little historical perspective. There's clear reasons why the U.S. has thousands of banks. The first one is, until probably the 90s, banks were not permitted to operate across state lines. Originally, they weren't until the 70s. They weren't even allowed to operate across county lines. And so by definition, you had to have thousands of banks because you couldn't have interstate banks or national banks. Those laws gradually disappeared, but I think there's still a vestige of that. But then the bigger one is if you're a depositor at a bank, your deposit's guaranteed by the federal government up to $250,000. I've said before, we don't have a lot of community bookstores anymore in this country. But if you told every bookstore they could borrow $250,000 and that loan would be guaranteed by the government, well, then we'd have a lot more bookstores. And then you add in the federal home loan banks, which are also a sort of government subsidized source of funding. And you basically have like a class of creditors who are willing to lend to community banks at effectively no risk to themselves. So if you look more at the liability side than the asset side, that's why we have thousands of banks. And, there are true benefits to that. I mean, the community banks serve customers in a different way than the largest banks. I think they have high customer satisfaction. That includes mid-sized, certainly regional banks. Unless and until you're going to remove those benefits, I think you're going to continue to have lots of banks in this country. The challenge is again, in that sort of middle, where now you're thinking about, your depositors are not just insured depositors and the Federal Home Loan Banks as a creditor, but you're actually holding uninsured deposits, and maybe you're issuing market debt, which is more expensive. Again, that's why you come back to the long-term debt requirement. So now you're having to raise more undependable and higher cost liabilities in order to fund your assets. That's where the squeeze is occurring. Obviously, part of that squeeze has included post-SVB, high deposit betas, where deposits are pricing upward quickly and therefore compressing NIM and interest income. So I think that's where the barbell's being felt, is the folks that are actually having to fund themselves with uninsured deposits, CDs, market debt, where those costs are rising significantly, partly in reaction to Silicon Valley and its progeny.
How would you do things differently? Is the banking sector fine as is without Basel III regulations, and any distress that happens is just the natural course of risks in capitalism? What do you think is a viable alternative?
I think all the evidence is that the U.S. banking system, particularly banks $100 billion and up, have plenty of capital. Regulators and banks should have been more focused on interest rate risk. Although, in something of an apology for them, I mean, who could have anticipated 500 basis points of interest rate increases by the Federal Reserve in such a short period of time? I mean, that's absolutely unprecedented. It caught a lot of folks offside. I mean, some more than others. Obviously, SVB was the worst at managing that, but I mean, there were others who made the same mistake. In fact, I have on my desk, just as a lesson in humility, two analyst reports from December 2022 rating Silicon Valley Bank as a buy. So, they and their examiners weren't the only ones who missed it. I do think, one change that I think everybody thinks is sensible is, there was this so-called AOCI filter that allowed regional banks to not include in capital, the unrealized losses or gains on their securities held available for sale. That's clearly going to be eliminated, and they'll have to recognize that. That is, I think, a sensible and direct reaction to Silicon Valley Bank. I do think there's going to be a lot more attention paid to interest rate risk management more generally. I don't think folks were really thinking much about depositor concentration risk. You never used to ask yourself, do all my depositors know each other? Again, I think that was a very unusual situation. I think all the earnings reports, I assume your bank among them, the quarter after SVB emphasized, through pie charts, our depositors are diversified by region, our depositors are diversified by business line, because they were, which again is why, so SVB and Signature as well were such incredible outliers. I don't think that experience cautions for major changes in the banking capital area. I think if anything, with regard to market risk in particular, we're seeing significantly diminished liquidity in capital markets, including treasury markets, which used to be considered the most liquid market in the world. I guess they still are. It's just everything is less liquid. So I think you've already gotten to the point where they're overcalibrated. We have a lot of concerns about the Federal Reserve stress test as both a legal and policy matter, and the amount of capital that it's generating. And then you just look at, market indices. You got a lot of banks in the United States trading below tangible book value. If you compare, the performance of any banking index, whether it's the whole industry or the regionals versus the S&P 500, the results, in the last 10, 15 years have been dismal. And you frequently hear, folks on analyst calls saying, banks are uninvestable. That doesn't seem like a clarion call for raising their capital requirements and lowering their return on equity. And of course, we haven't really talked about it, but you're also obviously seeing the flow of business out of banks and into non-banks, which is kind of extraordinary because banks have a natural advantage, which is they have a low funding base in the form of insured deposits, to some extent flub advances. They have access to the discount window, so they should be the low-priced provider of credit and intermediation. But those costs, the regulatory and compliance costs are now getting to be so great that they are offsetting, all the natural advantages. And I think, everybody's now talking about the move there, and nobody really knows what to do about it. I mean, I think the regulators are all unhappy that it's moving to the unregulated sector. I think they all have in their heart of hearts some hopes that means they get to regulate the unregulated sector. I think that's unlikely, but I just think it means that there's going to be a lot of risk out there that is not as capitalized and does not have a lender last resort behind it, as you see in the banking industry.
That shift of capital from banks to non-banks, I think, goes back to a point you made earlier, which is that capital flows oftentimes in the path of least resistance, and so that's where Basel III started from, was trying to make uniform regulations so there was not a race to the bottom. But it certainly is a component of it as we look at the pros and cons of these different regulations. So I want to close by just looking at 2024 landscape for this regulation, considering all the pushback that we've seen from banks and even some members of the Federal Reserve. Where do we stand in this process? What are the odds that it goes into effect in its existing form? I know we have elections in November where both houses of Congress are up for grabs, the White House is up for grabs, and that can change who is in a seat of power at the Fed and different regulators to some extent, but some of those people will still be in place. So where do you see right now, end of February 2024, what are the odds that Basel III gets enacted as it is, and what does its future look like?
Well, I'll do substance and then process. I mean, on substance, I think you can expect substantial changes to the proposal, certainly around credit risk, where, for mortgage, retail, small business loans, there's been, I think, a quite reasonable outcry that this is over-calibrated, both in terms of real risk and even relative to the Basel standard and the adoption in other countries. So I think, that will certainly be reformed. I think, similarly with regard to operational risk, which we haven't talked about a lot, there's a massive overstatement of operational risk. Our data show that really the worst year for operational risk losses, which again in reality is basically litigation losses for the U.S. banking industry, was 2014. That's actually when all the sort of mortgage judgments, or most of the mortgage judgments, were settled. This proposal requires capital 3.5 times the level of 2014. That is completely unjustifiable. So I think you'll see large changes there. Market risk is the most complicated and has a lot to do with how it overlaps with the Federal Reserve stress test. But I expect that there will be changes there as well. So the substance is, whenever it happens, the substance, I think, is going to change a lot, consistent not only with good policy, but also with, the pressures from bank customers and congressional leaders. The tougher question is when that's going to happen, and I think that's very much up for grabs. I believe Chairman Powell is testifying in early March. I'm sure he's going to be asked about that. And really the question is, are they going to have to repropose some or all of it in order to get the numbers right and get them back into the realm of reasonability? If they repropose it, it would be very hard for them to get this done in 2024 before change of administration, if there is one. But that's pretty speculative at this point. But, obviously, if this went into 2025, the range of possible outcomes gets very wide.
Greg Baer, thank you for coming on the podcast.
Oh, it's been a delight. Thank you.
That was Greg Baer, President and Chief Executive Officer at the Bank Policy Institute. I think what stands out to me about that conversation is how Basel III aims to make the banking sector more resilient by focusing on capital requirements that have very questionable value in our current banking environment. The ideal regulatory structure finds the right balance between sector stability and access to credit, but some regulations can curtail banking activity without doing much to lower systemic risk. Although regulations might always have a bias towards addressing the last crisis, it's important to evaluate the trade-offs and allow policy to be flexible in order to adapt to a rapidly changing landscape. Next week's busy data calendar starts with the February CPI on Tuesday. Core CPI inflation is expected to have slowed somewhat from the 0.4% increase in January to 0.3%, but this report will be even more important than usual because of the broad-based inflation acceleration the month before. The PPI and retail sales reports on Thursday will give additional insights into how much January data were anomalous or the potential beginning of new economic trends. The Fed begins its pre-meeting silent period tonight ahead of its March 20th decision. Market expectations are squarely set on the Fed keeping rates unchanged at its meeting this month, but the focus, as usual, will be on the next summary of economic projections in Chair Powell's press conference. Considering recent communication from Fed officials, we expect the new dot plot will show a median projection for 3 rate cuts this year, as it was in the December dot plot. We also expect some new guidance on the Fed's balance sheet management at the March meeting. Powell mentioned in January that a more in-depth conversation would take place to develop a framework for any potential changes to current quantitative tightening. Our baseline expectations for the Fed to slow its balance sheet roll-off so it can better determine where the ideal size of its balance sheet is without putting unnecessary pressure on bank reserves. Treasury auctions for 3-year notes, 10-year notes, and 30-year bonds will also be next week. The first auctions for these securities after the February refunding announcement went relatively smoothly, though other coupon auctions last month were a little weaker. The timing of each auction during the busy data week could also distort some of the auction performance. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.